Hello, and welcome to Economy Disrupted. I'm Matthew Goodman, Senior Vice President for Economics at CSIS. Delighted to have you with us. Today, we're going to talk about the impact of COVID-19 and the outlook for the global economy. If you have questions while we're doing the interview with our guest, please submit them at csis.org, Economy Disrupted.
And I'm Stephanie Segal, Senior Fellow with the Economics Program at CSIS and co-host of Economy Disrupted. Welcome to episode 3. We're going to plan to wrap up today around 3:20 with a segment called The Bottom Line, so we hope that you can stay with us until the end. For this episode, we're very happy to welcome Dr. Gita Gopinath as our guest. Gita is Economic Counselor and Chief Economist at the International Monetary Fund. Gita, thank you so much for joining us today.
Thank you, Stephanie and Matt. Really happy to be here.
So we'll just jump right into it. We now are just a few days out from the IMF and the research department updating the global forecast. It's updating that forecast against the backdrop of a pandemic now that has upwards of 10 million confirmed COVID-19 cases and sadly, more than 500,000 deaths from COVID-19. At a global scale, the pandemic doesn't really seem to be showing signs of abating. And of course, there are economic impacts from that, those impacts being the topic of the update that was released last week. So first, I guess if you could just give us an idea of what was in that update and what are the key drivers behind the forecast.
Stephanie, there were two main pieces to the update. The first is that we are projecting a somewhat deeper recession in 2020 as compared to what we did in April. And a second, we are forecasting a slower recovery in 2021. So in terms of the specific numbers, we have growth projected to be minus 4.9% of the global economy in 2020, which is about 1.9 percentage points below what we had forecast in April. And then we have a recovery of up to 5.4% in 2021. However, combined, that is, you're looking at a global economy that's only just ever so slightly bigger than what it was before the crisis. So, there is a lot of growth that's being lost, and the recovery is highly partial.
So one of the things that really stands out, and this is standard when the IMF forecasts, you look at what's happening with advanced economies, with emerging market economies, and low-income economies. So you can see kind of the differentiated impacts, but it's bad for everyone. It is less bad, I would say, for certain countries. The one that really stands out among the large economies in the updated forecast is the fund still has China forecast as experiencing positive growth for 2020, which is really an outlier among the large economies. Could you kind of walk through what is it that is allowing China to achieve depressed growth relative to the past, but still positive growth for this year, and compare that with what we're seeing in other both advanced and emerging market economies where we've had downward revisions of a few percentage points?
That is a great point, Stephanie. Indeed, China is, I guess, the one major economy and that is projected to grow at a positive rate, so 1%, and then it rebounds to 8% in 2021. I think the main reason is that while the epicenter of the epidemic, the pandemic, was China initially, but they've had relatively greater success in containing the virus with a shorter period of very strict containment. And they've started reopening, and of course it's a bit of a, it's a tricky reopening, but still they were one of the first to get off the bat in the sense of starting February onwards, they had reopening beginning. And you're seeing a pretty strong recovery, especially when you look at indicators like industrial production, manufacturing. Now, when you look at private consumption, service consumption, you still have some weakness there. But still, the fact that containment has been relatively more successful than other parts of the world, and they've also put in substantial fiscal support in what we call on-budget support, along with significant monetary policy support. And that combination has helped China recover relatively more strongly as compared to other economies.
Actually, on that point, the fiscal point, I think Matt actually was going to pick up on some of the fiscal policy, the role of fiscal policy in this crisis. So
if I could, Gita, let me ask you about fiscal policy and its implications. You have a very helpful tracker at the IMF of country by country fiscal policy responses, and we rely on that quite heavily. We appreciate it. This does have implications for debt and deficit spending. And the question is, since there's not going to be probably a rapid recovery, there may be a need for additional fiscal support. Do you think that there are limits to, to deficit spending and debt sustainability? How worried are you about that?
So we have about 11 trillion, close to $11 trillion of fiscal support in the global economy. Now, most of it is by advanced economies and lesser by emerging and developing economies. That's because they're also more fiscally constrained. And about 50% of that is what we call on budget, which is in the form of transfers, cash transfers, wage subsidies to firms. And the remaining 50% is below, which is that takes the form of loan guarantees, equity injections, and so forth. Now, if you take these measures and you look at what's happening to debt, debt is projected to be at the highest level ever. So even than what post-World War II peaks. So we're looking at very high debt levels. But the question you're asking is, well, we're obviously not out of the woods, which means more spending is needed. Now, for a large number of advanced economies, they certainly are in a situation where interest rates are expected to be low for a long period of time. And this is a crisis which is, once the health crisis is over and you have more stable reopenings, you're going to see a big spurt in growth. And so that's going to help with the debt dynamics going forward. On the other hand, there are, of course, many emerging and developing economies that have more constraints in terms of how they can finance themselves. And here, the international community has to play a very important role. I think the fact that financial conditions are relatively at this point in time is helping many economies. They're able to access markets. But otherwise, international institutions will have to provide concessional financing, liquidity lines, credit lines. And then there are going to be poorer nations that will need just outright debt relief, in some cases debt restructuring. So it's going to require a combination of these measures, but there is going to be a continued need for spending going forward.
Well, you touched on the monetary policy efforts by especially advanced economy central banks. We've gotten a lot of questions before the event today about that subject and the relationship or the concern that central banks may have been doing too much, and that might prevent some of the needed restructuring by individual firms and even failures of firms that's needed to sort of provide the basis for future growth. You yourself have spoken about, the disconnect between financial markets, that sentiment that seems to be very strong or has recovered at least, and the reality of the real economy that is not so certain. And I wonder if you could comment on that and how concerned you are about central banks maybe doing too much and what the implications of that are for longer term economic growth. I mean,
I think the first order thing is that it's good that we don't have a financial crisis right now. I mean, if we had a financial crisis on top of a real crisis, the projection had looked even more worse. So monetary policy, central bank policy around the world, and especially by major central banks, has absolutely helped in that regard. It's also helped prevent large-scale bankruptcies and so forth. Now, what's happening with markets is, indeed, it does look like there is a disconnect between financial markets and the real economy. I can think of three reasons for it. One is this substantial policy support and the expectation that interest rates will stay long for a very long period of time. I think that's one important factor for the stock market. The second important factor is that there is still tremendous uncertainty about what the path of the recovery would look like. So even in our case, we provide an upside scenario and a downside scenario relative to our baseline, where if there's better news on treatments and vaccines, you could have a faster recovery. And I think markets are putting more weight on that positive scenario. And a third aspect, of course, is that if you look at who the crisis is impacting most, it's affecting a lot of micro enterprises, directly. Those in the hospitality sector and leisure services and tourism, and those don't show up in the stock market. So there is a bit of what we call a compositional disconnect between the stock market and the real economy, and that's another factor. Now, we do want monetary policy to remain accommodative. We do want financial conditions to remain accommodative. But at the same time, it is important to ensure that there's not excessive risk-taking happening in the economy, because that could then set you up for much, for greater, if there was a tightening in financial conditions, then of course things could go bad very quickly.
Interesting. Thank you. Stephanie?
If I could just stick on this topic of some of the different sectoral impacts, and I think this is partly what Matt was alluding to and what some of the criticism of the very accommodative monetary policy is there a chance that firms that actually would need to fail or need to be restructured are avoiding that outcome, at least in the near term?
Stephanie, I cannot hear you at this moment.
Matt, are you able to hear me?
I can hear you, yes. Gita, can you hear me?
Can you hear me?
We may have just lost Gita for a second here. She's going to try, I think, to get back in.
Yep.
There we are. I think you're back, but there we go. Through the magic of the internet, you're sideways. There we go. Perfect. Can you hear us now, Gita?
I can hear you, yes.
Okay. And Stephanie?
Great. Yeah, I was getting it. I think one of the pieces that Matt was asking about are the criticism of perhaps doing too much, and that is that different sectors are really being impacted in very different ways in this crisis. And the WEO update actually gets at some of the sectoral impacts. I'm wondering if you could talk a bit to which sectors and which economies, in that sense, given kind of the outsized role of certain sectors, which sectors and which economies are actually being most hurt by COVID-19 now, and I guess kind of in the recovery?
Yes, Stephanie, I think what we're clearly seeing is sectors that require, human contact, physical contact. So most kind of leisure, services sectors, hospitality, tourism, travel. These are the sectors that you see have been hit dramatically. And as countries reopen, while you're seeing recoveries in other sectors, you're seeing much weaker recovery in these sectors. And so this is the sense in which countries that rely very heavily on tourism, they're going to be economies that are going to have a much slower recovery coming out of this crisis. And of course, the other set of countries are the countries that are major commodity exporters, with a big drop in demand for travel. You also have a drop in oil prices. You've had, it's come up relative to its March and April lows. But still, the path for oil that we are projecting is still lower than what we had projected before this crisis. And so they're going to have also a much weaker recovery relative to other countries.
Well, and just following on the sectoral impacts, the update notes the particularly acute impact on low-skilled workers and the catastrophic impact on the global labor market. That actually feeds into the issue of inequality. And I know the fund has done work looking at inequality predating COVID-19 and the fact that we've seen widening inequality prior to this crisis. But the concern now is that as a result of the crisis and on the other side, we could see even wider income inequality, both between countries and within countries. Can you talk to how the fund sees this issue of income inequality and what it is advising countries to deal with the inequality impacts of COVID-19?
Yeah, no, without a doubt, this crisis is affecting low income and low skilled workers the most. And you see that in terms of most of these people are hired in sectors that are being most dramatically affected, the ones I talked about, hospitality and tourism. And if you look at unemployment claims, that's where most of the lost jobs are coming from. So given that we expect these sectors to remain weak for a while, the hit to their incomes is going to be quite large. And so there will be this increase in inequality, and we've seen it after, if you look at history and if you've seen this after other kinds of natural disasters or epidemics, this is what you have seen. What does this mean in terms of policy response? What it means is you need a strong social safety net. And I think this crisis has made that abundantly clear, that countries that have strong social safety nets in place, that have strong healthcare facilities for everybody, these are the countries that are able to help their people much more quickly and have the potential of coming out of this crisis much faster. So in terms of our advice, of course, there is the now, which is about making sure that governments ensure a livelihood for all the people who are associated with these sectors and losing their incomes. And many governments have done that in the form of unemployment insurance, wage subsidies, cash transfers. So there's a lot being done on that front. Looking forward, of course, there's going to be this additional need, which is that some sectors will probably shrink in size in terms of their demand that they get. So you will have to have systems in place to reallocate workers towards growing sectors. Now that would require retraining, so you would need spending on that front. And also you might have to encourage firms to hire some workers who are at the greatest risk of being what we call long-term unemployed. And so hiring subsidies for them would help. But again, from a medium to long-term perspective, inequality is a reflection of the lack of opportunities for people. And that's something that needs to be fixed. And it is part of our advice to countries and what we do in, for instance, our Article 4 surveillance, to let them know about the need for education facilities that are equally available, healthcare facilities that are equally available, and so on. So these are the different buckets in which we are thinking about these issues.
And if I could follow up on that, I mean, everything you just said, I presume has been in some form part of what you've already been doing for years at the IMF through Article 4s and other efforts that you've pursued for decades. And yet this crisis is sort of unprecedented, and we've never had quite such a global pandemic that has had such a severe and rapid economic impact. And I wonder whether that has in any way what lessons you've learned from that, and what you've taken away from this particular crisis that is new and different, and that you think will you may apply in future to the kind of advice you give to countries. And if I can just finish the question in a more broad sense, sort of more broadly, what other lessons learned about this crisis for all of us would you emphasize here?
I mean, this crisis has made it absolutely clear that it's important to have wide social safety nets in place and good health care capacity and health infrastructure that is accessible to all and at affordable rates. And because, once a crisis hits, you scramble to do the right thing, but when the systems are not in place, it's just that much harder. And you have longer implementation lags and the possibility that the money doesn't really reach the people who need it. Now, this is a bigger challenge for countries, for instance, that have large informal economies, because it's even harder to reach them. So for those economies, our advice is to scale up on digital forms of payments. And because countries that have had that have been able to reach their workers much more quickly. And at the same time, very important to have strong communities and local. That's another quicker way to get there. In terms of inequality, I also want to flag one more thing, which is that, the last few decades, we've seen a great convergence of emerging markets to advanced economies in terms of their income level convergence. But this is a crisis that's really going to jeopardize that quite significantly. If you look at our projections for developing economies, if you look at for the emerging developing economy group, if you exclude China from it, we have a projection that says they're going to be hit much more harder than advanced economies will be over a 2-year period. So again, we have this risk of income divergence across countries, which will be another challenge for the international community.
helpful. Thank you. The IMF has really stepped up, and I think, as in the global financial crisis, really been one of the first movers in responding to all of this. Two-part question about that: is the IMF overextended now? Are you worried at all that you've got sort of not as much capacity as you need to be able to continue to deal with this and other problems? Because it's not like other problems in the world have gone away, so you're going to need resources and capacity to deal with other issues. So that's one question. And then, well, let me just stop on that. I have a slightly different question as a follow-up.
So we had a large number of countries come to us for emergency assistance, which is what was kind of unique about this particular crisis. We had over 100 countries approach us. We have dispersed rapid financing to over 70 countries in really record time. We expect more countries to need funding going forward. Now, in terms of our overall lending envelope, that's about $1 trillion. We already have $250 billion lent out, so we still have $750 billion of capacity that we can lend. And as of now, in the absence of a financial crisis, the fact that many economies, emerging markets, have access to market access, are able to borrow at somewhat reasonable rates. So we don't have a huge demand coming from them at this. But that doesn't mean that we are out of the woods, because we could have a second wave, which would be quite severe, for instance. And then that could trigger a financial crisis, and then we would have an even bigger demand for our resources. So I would say, as of now, we have what we need. But if things were to get much worse, we might need to have access to even greater resources.
The other question was, at least in my mind, related, which is about sort of broader things that the IMF thinks are needed. You make a call in the World Economic Update, the WEO update, the World Economic Outlook update, for greater multilateral cooperation. And what does the rest of the global system need to be doing here? In the global financial crisis 11, 12 years ago, the G20, for example, stepped up. A group of individual countries stepped up and agreed on sort of with common purpose to do individually and collectively a bunch of things. Frankly, that has not been as obvious this time. There is the debt service initiative, which has been positive. But other than that, it's hard to see kind of what the G20 has done constructively, frankly. At least that's my view. Enlighten me if they've done other things. What else should the multilateral community be doing in response to all of this, the health and economic crisis?
Right. So soon after the global financial crisis, there was a big push to increase the IMF's lending envelope, and that's how we got to $1 trillion capacity, right? So, we are in a good place in that sense. In terms of the global financial safety net, of course, it's much more than just the IMF. You also have major central banks that have been providing swap lines to other countries to make sure that the US Fed, what it did, and to ensure that there was smooth dollar liquidity in the global markets. That has helped many countries. You have the G20 debt service suspension initiative, which is, you can look at it as half full or half empty. I like to think of it as half full. I think that this is a very important step that has been taken by all these countries, and it will need to be continued. So in terms of what I think would be needed even more of, let me list a few. One is, this is first and foremost a health crisis, which means that to solve it, we will need a solution, a health solution that makes this a less life-threatening virus. And that would mean that you would need that once you have treatments available and maybe vaccine available, you should be able to produce that at scale and be made affordable to the planet. And that, as I think, an area where a lot more needs to be done, because I think we're quite behind the curve over there. Secondly, this is a crisis where poorer nations were going to have to spend to provide healthcare services to their people, to make sure that their basic livelihoods are met. And so spending will be needed. And so that would require access to concessional financing, aid, grants for these nations, and debt service relief. Now, again, that's in that IMF has done, has contributed in all those different dimensions. My guess is that going forward, there will be even greater demands for it.
Helpful. I want to make sure we have give the audience a chance to ask questions. So let me remind you again, if you'd like to submit questions, you can do that through the web link that you have. We already received a number of questions, and Stephanie will go to those in a second, unless you have your own additional questions, Stephanie.
Well, I see we're getting some questions on this, and I had one as well. Matt, you and Gita were just talking about the debt service suspension initiative. I believe the managing director of the IMF has also talked about broader principles that might apply beyond just official sector creditors, and thinking about private sector involvement and the need for future debt restructuring depending on the trajectory of the virus as well as the economic response. Can you give us maybe an update? You said, DSSI glass is either half full or half empty, depending on your perspective. But what are some of the considerations there as far as where that initiative stands? And then if we look at something that might be even broader, including private sector obligations, what the fund's role might be in addressing some of those private sector issues?
So we are working closely with the G20 on the DSSI in terms of providing technical assistance there. The way I see it is that this is a crisis that's going to leave economies smaller, significantly smaller than they were projected to be before this crisis hit. At the same time, this is a crisis that calls for significant spending. And so there is a need for financing, for them to have access to resources. And the international community has to play an important role over there. So the debt service suspension initiative is very important in that regard. It goes through for about a 6-month period, but I suspect it will be needed for longer than that for the poorer nations. It is also important, and we absolutely would want the private sector to also be involved in an equal way with providing debt relief to these poorer nations. And I think that would be essential. Now, going forward, we can see a situation where there are some countries that come out of this crisis with very high levels of debt, and it might require debt restructurings. So, all of this is on the table. Difficult times. They cannot be saddled with very, very high levels of debt. The poorer nations cannot be saddled with very high levels of debt going forward, and they will need debt relief.
Thank you for that. Why don't we do have a number of questions that have come in from the audience, and encourage people to submit your questions here. We were talking before we went live about the last time you were at CSIS, which felt like eons ago, but it was to talk about the fund's work on exchange rates. We did get a question asking you to predict which will be stronger in the next months, euro or dollar. I won't ask you to answer that question specifically, but maybe given that exchange rates are the result of macroeconomic conditions, can you talk about how you see exchange rates evolving, and whether or not the current crisis could actually represent some big shift in the international monetary system when it comes to exchange rates and dominance of certain currencies?
So a lot of what we're seeing with exchange rates is business as usual, which is that when you had risk-off episodes, and this happened, for instance, in March, you had a rallying of dominant currencies, which the biggest is the dollar, and the dollar gained in strength. When there was a strong policy response, and you moved off from risk-off to now what looks like a risk-on episode, at least tentatively, then you've had the opposite, which is you've had the dollar lose in value or depreciate relative to other currencies. So that is what we have seen before. I think what's a bit different from the global financial crisis is the the fact that the financial markets rallied so much more quickly, despite the fact that there is considerable uncertainty on the health front and what we're seeing in terms of real activity, has also meant that the size of the depreciations that we've seen in many countries have not been as big as the global financial crisis, except for commodity exporters. For commodity exporters, you saw really big movements, and now you've seen recent appreciations there too. So a lot of what we're seeing with exchange rate movements is what one would expect. I think a concern for many emerging markets is if there is another round of real financial stress, then the lack of dollar liquidity will again become a problem. And then again, we'll see how major central banks can help with that. And we have providing flexible credit lines to countries, which is one way of ensuring that you have the international liquidity that you need whenever that comes about. In terms of what this means for dollar dominance or the dominance of certain reserve currencies, I think this. As of now, I wouldn't say that this dramatically changes the prospects for the dollar at this point. Almost all countries are being hit, not almost all, I would say all countries are being hit dramatically by this crisis. And being a dominant currency status is a relative status. It's a question of which currency does better than the others. So as of now, I don't see a big, but I can see going forward that this crisis will probably trigger accelerate move towards digital payment systems, digital currency, central bank digital coins. I can see how this can trigger those kinds of developments and accelerate those developments even more.
Yeah, and the questioner didn't ask this point specifically, but I'm guessing maybe this is what they had in mind in comparing the dollar to the euro. But could you talk a bit about the steps that Europe has taken in response to the crisis? And specifically, there's been this talk about kind of a disconnect historically in the euro area between unified monetary policy, but very fragmented fiscal policy responses. Europe has responded to this crisis in a way that addresses at least partially that fiscal concern. What does that mean for the outlook of currencies and Europe as a region?
I think what we have seen is, very impressive reaction in terms at the EU level, in terms of having a more EU-wide took one big step when they had the 540. More recently, the EU recovery fund. The proposed EU recovery fund of $750 billion is another major step in that direction. I mean, one should not, reduce the importance of it. It is a significant amount, and it has significant macro consequences. So these are very important steps in the direction of having an ever closer European Union, and one side effect of that is indeed strengthening the value of the euro in international markets, because what is important is to be able to say that this is a currency that is resilient. For the currency to be resilient, you need that the euro area is resilient. And these kinds of European Union-wide support absolutely helps in raising the value of the euro.
So we have a number of questions that sort of get to the U.S. economy, and let me sort of bunch those together if I could. One is interested in long-term impact of COVID-19 on the U.S. economy. Does the IMF have any specific advice for investors and companies how to prepare sustainably for the future after the pandemic? So that's one question. Another questioner asks, is there a possibility of negative rates in the US as in Japan to stimulate the economy and get growth back on track? A different question about the US. And then a third question about the US, which I'm sorry, I have to go to my chat function here. Yes, what would a US economy quarantined from much of the rest of the world mean for global growth? How long can whole countries or regions, Australia, New Zealand, Europe, be walled off? So sorry, those are three rather different questions about, the impact on companies and investors in the US, about interest rates, negative rates, and about sort of the US being somehow walled off from the rest of the world.
So on the first piece, what we have in our projections is that the US economy is going to be hit very badly this year, -8%. And then we have a jump up in growth. But if you add the two up, we are still projecting that the US would remain, even by the end of 2021, below its pre-COVID levels. So even below the GDP in 2019. So that's a pretty persistent hit to the economy. Projecting even further out is harder. We just, again, even between now and the end of 2021, a lot can change. So we have downside scenarios where you can have second waves. And if there is a significant second wave, we've simulated that, and that would basically wipe out growth from the global economy. So we are now projecting growth of 5.4% in 2021, but if there is a major second wave, then our projection says growth is going to be 0%. So clearly, these are dramatic hits in terms of sectors. Again, sectors that are much more digital, healthcare, more technology sectors where you can work from home. Those ones are, as you see, are recovering much faster. But on the other hand, when you have more, contact-intensive sectors, which are not essential services, so hospitality, again, like I said before, travel, tourism, those are, and sectors related to those are being hit quite badly, and the recovery is much slower. I think as of now, government support systems are helping many of these firms continue and stay active. But if this crisis continues for much longer, I think governments will have to make a difficult decision about which companies to actually bail out and which ones they cannot do so. So I think that will be a decision that they will have to make. And the kinds of sectors that are more contact intensive are the ones that will be more harder hit. On negative rates, I think the Fed has been quite clear about not wanting to venture in there. And again, for this crisis, at least at this moment, it's less about the interest rate and more about what kinds of liquidity facilities and what kinds of asset purchase facilities you have. So I think that's where most of the attention will be. And then the last thing about whether the US might be walled off from the rest of the world, I think it's very important for very quick containment measures to be put in place. And by containment measures, I don't necessarily mean wide-scale uniform lockdowns. I mean kind of smart lockdowns, which are much more targeted, which involve widespread testing and contact tracing. Those kinds of measures to bring down to keep the number of cases under kind of, to manage the number of cases that you have. I mean, that will signal to the world that these policies are going well. And those are going to be absolutely essential. It's not just for the US, but pretty much all countries in the world.
Okay, thank you. And that was quite a broad set of questions and well answered across that range. Stephanie, are there other questions that we should ask?
Yeah,
we probably have time for one or two more.
Yep, there are a couple of questions here. I'll partner up maybe questions about the US economy with a few that we received on emerging markets. One specifically with regard to India, and I did see that the update actually had a pretty significant downward revision in the forecast for India's growth. So the question is, how should India respond to the current economic downturn? And how should Indians tackle the situation? And is the government taking the right track? Another EM specific question relates to Latin America, and actually a similar question. What is it that countries should be doing to come out of the crisis, in particular if their fiscal resources are constrained?
So, I mean, let's start with a set of similar features between India and several Latin American economies, which is that these are countries that have dense populations and a large amount of urban concentration in terms of the population. And that makes this health crisis a bigger challenge. I mean, there's no two things about it. It's harder to do social distancing in these economies than in others. And so what we are seeing in both these parts of the world is you are seeing that despite some very stringent lockdowns, for instance, in India, you've had an increase in cases and the health crisis is not abating. The number of new cases continues to grow. So that is a major important challenge, and it's one of the reasons why, for instance, for India, we had very large downgrades, and similarly the reason in Brazil and Mexico. In terms of what needs to be done, again, all these countries are not exactly the same. They've been doing different measures. I mean, I can talk very quickly about some of them. In India, if you look at the whole package of fiscal, monetary, and financial market support, that has been substantial. We see that there is greater scope for doing more direct income help, providing direct income help to the vulnerable population and for small and medium enterprises in India. And also we see the scope for monetary policy, further monetary policy easing. If you look at, in the case of, countries like Mexico, for instance, we also think, in the case of Mexico, we think that there is absolutely scope to do more on the fiscal and the monetary front. Again, it is a challenge for emerging markets to do the kinds of spending that is needed. They don't have the reserve currency status that advanced economies do. But at the same time, because the global economy and all the major central banks have cut interest rates dramatically, many of them are borrowing now at lower rates than they did before the crisis hit. And financial market conditions are relatively stable. So if you can borrow, and you can borrow it at longer maturities, this will be the time to do it. And also, the counterfactual is much worse, which is that if if you end up not doing these kinds of essential spending, then you can end up with even worse fiscal positions. Again, I think it's also very important to have fiscal transparency, fiscal accounting, and a medium-term fiscal consolidation plan.
So if I could just ask about one other part of the world, which is Africa. We have a question there. It relates to the debt sustainability questions that you've already touched on, but it's asking about many countries in Africa already under heavy debt burdens, multilaterally, bilaterally, especially with China. Additional loans are being granted. Debt servicing is going to consume an increasing chunk of their revenue post-crisis. Will this have implications for investment in capital projects, social services? How would the IMF advise these countries to balance those competing needs and priorities?
So the priority right now is the health crisis. It's not over, and governments need to invest on more healthcare capacity. Again, a lot more testing, a lot more contact tracing, and a lot more personal protective equipment. So that's absolutely essential and first order at this point. Going forward, of course, the Sustainable Development Goals are important to achieve, and it's challenging. It's the financing, the funding challenges are tremendous over there. But again, in terms of what the international community can do, there will absolutely be a need to provide grants and provide aid. And also for the debt service initiative. I mean, this is something that is front and center. All of the international financial institutions are dealing with this. Countries are dealing with it. And they will need debt service. Poorer nations will need debt service relief.
I think we've got maybe time for one more question. And it's one that is not specific to COVID-19 and the pandemic, but it shares with COVID-19 the global nature and the term crisis, and that is climate crisis. The managing director in the past week has talked about the urgency of addressing climate change. And I'm wondering, for the IMF to be engaged on this issue, what is it that what is the role for the fund when it comes to addressing climate change, encouraging multilateral action, which we've talked about before? What's the fund's role here? So firstly, yes, using this crisis and coming out of this crisis towards a much more greener world, a greener planet, is hugely important. As countries are thinking about investing in recoveries, doing that by investing in physical infrastructure that's planet friendly will make a big difference. It's also one of those, physical infrastructure investment is also one of those methods of
generating a job-rich recovery, because this is going to be a crisis that's going to have a lot of joblessness, and that will be needed going forward. In terms of what the IMF does is, of course, besides providing capacity training, technical assistance to countries, it's also now part of our Article 4 surveillance, where we pay close attention to what countries are doing with respect to the climate challenge. That we can give specific advice on what kinds of policies will help. We also think it's very important to have a common agreement, a common set of standards on what's considered green investment, so that that it's actually money that's being raised is used for the purpose that it's been raised for. And there are developing nations and poorer nations that will need assistance to deal with climate disasters. This is not the COVID-19 pandemic is not the only natural disaster that's going to be there. There have been many, and there will be more on this front, weather-related front. And so we have what we call a catastrophe containment and relief trust that is meant for helping countries. But we are working very closely with our membership to think about how to make a green transition. What do we need for carbon mitigation and carbon adaptation? Because for many of our membership countries, especially the small islands, this is almost an existential question at this point.
Well, this is terrific. Unfortunately, this is all the time we have. In a minute, we're going to wrap up with our usual final segment, the bottom line, so please stick around for that. But for now, let me just thank you, Gita. That was an incredible tour de force. It's easy to ask a broad range of questions like that, much harder to answer them so crisply and with such power. So we really appreciate that. And thank you for joining us. We enjoy working with you and hope to have you back.
Thank you. Thanks, Matt and Stephanie. Really appreciate
Thanks so much.
Asking me to do this.
Keep up the good work. The IMF is just proving its value every day. So we really appreciate what you do. Thank you. So with that, we are going to just make one service announcement, which is that we are going to meet again on July 17th, and we'll have Eric Schmidt, the former CEO of Google, on with us. So please stay tuned for that. A little bit longer break this time, but we'll be back on July 17th. And now I'm going to turn to our segment, The Bottom Line, and delighted to introduce our senior advisor, a non-resident senior advisor to our program, Mark Sobel, who many of you know was longtime U.S. Treasury official and executive director to the IMF. So delighted to welcome Mark to this final segment. Thank you.
Let me fit Gita's excellent remarks into 4 reflections on the coming decade's outlook. First, the underlying economic picture deteriorated over the last decade. Overcoming the global financial crisis posed a hurdle. Japan, America, and Europe saw declining potential growth. Borrowing was high. Monetary policy was challenged by zero interest rates. China's growth rates fell. Second, prospects for the 2020s were challenging before COVID. Advanced economies faced more of the same: sluggish growth and deflation, aging populations, the likelihood of restrained productivity growth, and tackling debt portended more modest sustainable growth. China, a key global engine, faces declining sustainable growth. Its population is aging rapidly. It's transitioning from an investment-intensive economy to one based on consumers and services. Increased statism will reduce efficiency. Its financial system faces huge vulnerabilities. China's sustainable growth rate could fall from 6% currently to 4% over the 2020s. Latin America and India face challenges too. Third, the pandemic will worsen this gloomy outlook. It's a huge cyclical economic blow. Notions of a V-shaped recovery are gone. Consumer incomes will take steep hits. Labor markets will scar. Restrained growth will hinder investment. Governments are correctly using fiscal policy to bridge the COVID demand collapse, but will likely shift to gradual consolidation afterwards. Further hurting growth, the virus may compound other factors: U.S.-China tensions, protectionism, reshoring, populism. Fourth, while I'm pessimistic, hope is not lost. Policymakers can act. Our economies are in dire need of smart spending that generates high returns. Infrastructure, greening, education. Also, the crisis may accelerate productivity-enhancing shifts underway. Perhaps artificial intelligence and other technologies can boost activity, though policymakers need to be prepared for the labor market impacts. The growth outlook for the 2020s is dreary. Perhaps we'll overcome that despite ourselves. I'm not counting on it.